Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast connecting you to the world of investing and helping you stay ahead. The Federal Reserve cuts interest rates by 50 basis points, its first cut in more than 4 years. We check in with Director of Quantitative Market Strategy, Denise Chisholm, to get her thoughts on the recent announcement and what it could signal for the broader economy. Denise said she expected the Fed to cut rates, but she's not so sure that there's going to be an instantaneous reaction in the stock market. She says there are very strong pockets of the market, small caps and parts of the consumer, that are very rate sensitive, that in some ways have felt the impact of the Fed's cycle much more than large cap corporate America. She says that's where the most excitement will be felt, but she adds that it doesn't mean it will translate directly into all stocks on the spectrum. Denise says real estate and financials are showing strong valuation support and wide valuation spreads and are something to consider as the current risk-reward is skewed to the upside. She also says defensive sectors such as consumer staples, healthcare, and utilities face margin and profitability issues. This podcast was recorded on September 19th, 2024.
Good to have a chance to speak with you. And I might say you told us so, actually, for a long time. 50. How did you see that?
Yeah, well, in my work, it just feels like, or I should say, based on the data, it seemed like to me that inflation was really not as much of a problem as many investors suspected. It was really all in the housing area. So when you looked at the CPI, the core CPI, ex shelter, we've been below target. Remember, the CPI runs a little bit harder than the PCE deflator, and we've been below that 2% target for quite some time. And I think that that's the key behind this 50 basis point cut.
I mean, just this morning we had initial jobless claims coming in. They actually weren't, they fell a bit from what expectations were. I know it's a weekly number, but it's one of those that sort of makes you go, well, did they really need to cut on the jobless story? Like, was the jobless story what they needed to attack?
So I think the jobless story is important from a risk management perspective, meaning if there is if there is less inflationary risk than they thought, then you kind of focus a little bit more on the full employment mandate, which is exactly what Chair Powell said in the press conference. But I do think it's really hard to walk away from the data and say, in like the payrolls, in terms of how much payrolls are growing, we've been here before. This doesn't look particularly recessionary. This was pre-pandemic levels. We've seen these levels of growth that's slowing, certainly much slower than we've seen over the last year, but we've seen it before outside recessions. To me, what strikes me as extremely rare in the data is the level of the Fed funds rate versus inflation. So that level is in the top quartile of all history, where they were at 525 versus the inflation rate, even core, not ex shelter, right? The core PCE deflator is now below 3. This only happens 10% of the time historically. This is the part that I think is rare. So again, when you think about, should we focus on the Fed, them cutting, them doing 25 versus 50, usually the answer is in the why are they cutting, which is unknown at the point at which they cut. But a lot of the other variables can actually give us signals. And one of those variables is the very one I just mentioned, which is to say, when the Fed is particularly elevated relative to the level of inflation, that tends to be very bullish for the market. And that tends to be very bullish for the market because it means that the Fed can cut to the extent that the economy softens. And that's the real critical issue, I think.
So, I mean, it means that if we're surviving above 5% with interest rates, we should fly if they're dropping. I mean, that's the conclusion that ultra bullish people would like everyone to believe.
I'm not sure I am ultra bullish in that way. And funny, I mean, you've heard me say that there's a positive correlation, not a negative one, to higher real rates. So the higher real rates have been, the more likely GDP is to grow. And it's usually a function of the fact that rates are more likely a function of growth, not a deterrent to it, which is to say quantitatively that the Fed more often follows the cycle rather than creates the cycle. So I think there are those that think there is going to be some kind of change in GDP trajectory of growth now that the Fed is cutting. And I will tell you, history says that you just don't see that historically. Usually when the Fed is hiking, GDP is growing faster than when the Fed is cutting. Sure, you can make that, counterfactual argument that maybe it would be growing slower had the Fed not cut. But barring that, it's hard to see a situation where the Fed impacts real GDP growth. It's also hard to see a statistical reason why the Fed influences the stock market consistently. If you look at all the 12-month rolling periods since 1962, and you say the Fed cutting or the Fed hiking, they relatively have the exact same returns. I shouldn't say relatively. They have close to the exact same returns at around your baseline averages, like 10 versus 9. So there's not a big pound the table, yes, don't fight the Fed. It depends on the situation. And I think that that's why you need to intersect it with another variable, because those variables matter a whole lot more than exactly what the Fed is doing. And I think one of the key variables that we've seen play out this year is stronger than expected earnings growth. And when that has been the backdrop historically, that's also been a pretty constructive signal for the market, because usually it means, if the why is most important, that the Fed is not cutting because they have to, because earnings growth is strong, which usually means that hiring won't contract. It is because they are cutting because they can.
Take us then into the discussion of kind of the consumer broadly, but really getting at the earnings, the margins, the profitability, because we hear that there's a maxed out feeling, which not feeling, but just, like that's growing, and that higher prices on everything is kind of bumming a lot of us out. Will the margins stick in the earnings stories? Question.
Now, I get that concern, right? Because there's certainly a lot of data that says the savings rate has been worn down, right? So the consumers are running out of that excess savings that they built up during the pandemic. Real wage growth is now slowing marginally, although it was contracting in 2022. I think that that's the difference when I look at the data. The most influential things on consumer spending are never the savings rate historically. First of all, that's the most heavily revised data point that you could look at. Let me give you one data. The Philly Fed did a study that in 1982 that they thought the savings rate was 1%, turned out to be 10%. The government finds income in retrospect all the time. And that's why that sort of the slosh number between spending and income is that savings rate. So that is the most heavily revised. So I don't like when arguments depend on the savings rate. The two most influential factors to how consumer spending does, or whether or not they, quote, run out of gas, which they rarely do, is real income growth. And that is positive for the first time. And I think, we just went positive, I want to say a year ago, after the deepest contraction we've seen outside recession ever in 2022. So we've got that being a positive tailwind. We've also got bank willingness to lend being a uniquely positive tailwind. Most Fed cutting cycles happen when banks have already been lending. Lending standards were already loose, and they are starting to contract. Our situation is the exact opposite, in the sense that bank willingness to lend was at recessionary and contractionary levels in 2022 and is actually recovering. And when you look from a variable perspective, like I said, the Fed doesn't really have a lot of statistical influence over GDP, doesn't have a lot of statistical influence over stocks, but it does have statistical influence over bank willingness to lend. When the Fed is hiking, only 25% of the time, banks are more willing to lend over the course of the next year. When they are cutting, 63%. When they are cutting from a contractionary rate, which is where the situation is we are right now, 90% of the time, banks become more willing to lend over the next year. So that bank willingness to lend, combined with real income growth, I think is a very good perspective for the consumer. And to your point on corporate profitability, we've obviously seen corporate profits grow. We're growing around 10% now. It's been driven by cap-weighted profit growth, less so on the equal weighted spectrum, but we are seeing both accelerate. As goods, and we can talk about crude oil as well, as goods prices come down relative to the pricing power of corporate America as measured by the CPI, I still see potential for margin upside. So there are some areas in the market that are certainly being squeezed, and some people point out industrials. But when you look at the aggregate measures and you look at the CPI versus the PPI, what you find is still a statistically wide gap, which would predict higher margins in the future. And I think that what crude oil has done recently is very important, because as much as not crude oil is not in everything all the time, it's a really important driver when you look at the corollaries behind goods inflation. So that might mean that goods inflation is much lower for longer than people thought. That's good for corporate profit margins, and it's also very good for the US consumer.
And can we extend the consumer, maybe some of the goods in the economy bit back to the financial sector? I mean, as a sector, do you like financials?
Yes. So I think all rate sensitive sectors really intrigue me. And I think that there's opportunities for a couple reasons. One is that while investors debate that, and it's true, that the Fed cut was already discounted in the bond market, I disagree completely that it was discounted in the equity market already. And that is rare, because most of the times the equity market is a very good discounting mechanism. What you usually see historically the year before the Federal Reserve cuts is interest rate sensitive sectors outperformed by about 1,000 basis points. That happens 70% of the time. We have not seen that. We're in the third of the time where interest rate sensitive sectors have actually underperformed by 1,000 basis points. If you look at that 30% of the time historically, you say, well, what happens next when the market mispriced this? Again, according to my definition, you will find one, a melt up in the stock market, and maybe melt up is a little bit of a strong word, but a continued boost in the overall stock market driven by a rotation into those interest rate sensitive sectors. This is happening at the time. Again, the market has not appropriately discounted a cut, in my opinion. This is happening at the time where both real estate and financials are showing strong valuation support and wide valuation spreads. I think both of those things combined make them unique in terms of attractive downside protection relative to the upside, to the extent that the news is not as bad as investors expect. So that's, I think, the positive risk reward. And when you look historically, back to crude oil for a second, as much as we are focused on the Fed and that 50 basis point cut, this is not the only stimulus that we are seeing in the US economy, right? Crude oil now, if you add crude oil, and look on my LinkedIn for these notes that will be posted soon, if you add in the interest rate cut with what we've seen in crude oil over the last year, the two things combined have actually gone down by about 50 percentage points. And that's important because it's pretty rare outside a recession that you see this level of stimulus. And there is a very linear monotonic correlation to the more stimulus you see in those two factors, the more likely you are to see the economy recover, earnings recover, stocks recover, and interest rate sensitives like real estate lead the market. This is a very pro-cyclical story. So there's a lot of investors out there that are worried about the defensive rotation that we've seen of late. Certainly utilities have outperformed handily. A lot of the work that I'm doing now suggests that that is likely to unwind based on what we're seeing in terms of the stimulus measures. I will say that there's a lot of focus on all of the headwinds that we are seeing in the market, right? You focused on margins as one, corporate profitability, the labor market. There's concerns about the election. We always find it very easy to focus on headline risk going forward. But I think we forget sometimes that why those factors are not important historically when we look at them statistically is because as a single variable, they tend not to be influential, partly because at the time that they happen, there might be other tailwinds in the market. And I think that this is a very potent and palpable tailwind, the combination of crude oil and interest rate cuts, that we rarely see, that's much more powerful than investors expect and are thinking about right now.
Well, the bad stuff seems to always be easier for everyone to believe, even though there's lots of good stuff floating around. I want to pick up on the word stimulus because I almost feel like you need to retrain us a little bit. Stimulus for the last 5 years has meant monetary, but it's also meant fiscal. And when I hear stimulus, I sort of think, because the world is still working it all off pretty handily. Stimulus from the price of oil dropping, stimulus from other types of things. Obviously, the monetary story is what it is, but just a bit about how we need to retrain when we think about stimulus in the market, making things positive.
Yes. So I think crude oil is one where you can just backtest statistically and really find the influence over the consumer. And it is really about, when you have a fixed level of income. When crude oil goes down, you pay less for gas, and then you are able to spend that slush fund in other places of the economy. Now, as it relates to fiscal stimulus, I think that this is the interesting one. So I've heard a lot of people argue that fiscal stimulus will keep inflation higher because of our deficit levels. I think that there are two kinds of fiscal stimulus. One is very impactful on inflation, and the other is, in my opinion, not at all impactful on inflation. So, the one that does have a very strong impact on inflation is transfer payments. When the government drops money on you in the form of a check and says, you all have $1,200, that is very effective at creating inflation. That is the
Helicopter
exact
money. Yeah.
Right. That is the exact kind of stimulus we saw in 2020. And it was the biggest proportion of GDP that we had ever seen in transfer payments, I think, in the history of the data that I have going back to the 60s. We do see that sort of stimulus impulse in prior recessions. We certainly saw checks written in the 1970s, in 1975, and then obviously in the financial crisis, although it was much delayed. This stimulus was very effective in the sense that it was large and it was instantaneous, which is fairly rare in histories. Other than that, government spending as it relates to programs in terms of either industrial policy or broad level spending, I find very, very tough to consistently relate to inflation. And again, you can look back in history and say the US, as much as the deficits are larger as a percentage of GDP, the US has run deficits throughout most of its history, with the rare exception being, I think, 98 and 99, when there was a surplus. And you can't find any consistent correlation to inflation because government spending is not particularly efficient. And there is not a lot of multiplier on that. So when people point to fiscal stimulus, either keeping the economy growing stronger or inflation staying elevated, I'm a little skeptical of that argument. The transfer payments are now over that we have seen. And we'll see exactly what happens in the future in terms of policy. But that inflationary impulse, I think, is in some ways gone. And I think that there is the increasing potential of a much more prolonged downtrend in inflation than I think that most investors expect this cycle.
Could it be deflationary?
It could in the end. And that is one of my concerns. And I think that, you can make the argument that the Federal Reserve has already made a policy mistake. I think usually when people talk about policy mistakes, investors really think that that means that there will be an impact on the market over the next 12 to 24 months. And usually the policy mistakes have mistakes that you look back 5 to 8 years and say, oh, there was the mistake, right? If you think about the financial crisis, the mistake really wasn't Ben Bernanke didn't cut enough in 2007. It was really that rates were much too low relative to the growth rate of the economy in 2000, 2001. So that policy mistake created a lending bubble and an excess in the housing market that begat the financial crisis. So even if you say that the Federal Reserve has been overly restrictive, and now we have the potential for the next cycle to end in a deflationary bust, as opposed to an inflationary one, that may still be years in the future. So we're still, I think that the jury is still out on that. But I am definitely on the side of, I would like a little more inflation, certainly than what we saw in the 2010s. I think that 2% target, in hindsight, is correlated with low real income and low real GDP growth. Something more in the 3% range also correlates with better real income growth, better profitability for corporate America, and better real GDP. So a little bit of inflation, as long as prices are stable, is not necessarily a bad thing.
It's interesting. I mean, you've had said before that the beginning of, because it does to an extent feel like a brand new world, a new paradigm, a new, whatever you want to call it, like markets are now going to react to a lot of things probably quite differently because we're on the road, and it does feel different. That said, I know that you've said that looking at the beginning of the Fed rate cutting cycle historically doesn't tell us a lot about how things are going to go. I'm kind of wondering about this new paradigm excitement, but we don't really know where that fits to you.
Yeah, the Fed does sort of look like, I mean, it's ironic that I say they look like more noise than signal in my work. And I say that because if you look at first Fed cuts, half the time they're cutting because they have to, right? We can pull out the financial crisis from that. We can pull out the tech bubble from that. And half the time they're cutting because they can, right? We saw that in 2018. We certainly saw that in 1994, all of those mid-cycle slowdowns that we forgot about. So when you get this sort of weird 50% hit rate, what do you do as an investor or as somebody who studies statistics? I sort of say, well, it doesn't really give you any informational content, which means that you need to really strongly think about the backdrop, which is to say that all rate cycles are different. We are gravitating towards this. Denise, give me a playbook. Tell me what to own, and because the Fed's cutting rates. And I will tell you, look, I think that you can get there, but you have to get there by saying, how is our situation different? And what do those differences empirically mean in the data? Our situation is different for three reasons. One, earnings growth is strong. Two, the Fed funds rate is elevated relative to the level of inflation. And three, bank willingness to lend has already contracted. These three variables have never happened together, right? So we don't have any analog. But if I analyze those three variables and what they mean, all three are bullish situations. When earnings is growing, that usually means, given corporate America actually hires people, it usually means there's a monotonic correlation that hiring is less likely to falter or layoffs are less likely to happen. And when the Fed is very elevated relative to the Fed funds rate, as I said, it more likely means that there is a Fed put because the Fed has optionality, which we have not seen in the better part of 15 years. And more importantly, bank lending standards, if they have already contracted, there has been some cycle reset. And that's the very unique part of this cycle, is that we're not at the point of the excess where the Fed has hiked into an excess. We were at the opposite side of the ledger, where we already see the contraction in real income growth without a recession. We didn't see any job loss associated with it, but we did see a corporate profit contraction, and we did see a peak to trough reset in the market as well, of a typical correction that you see in a recession of peak to trough 30%. So that's very different. So this situation that we are in has never happened before, but when you look at those variables, all three of them skew bullish. So I think that the risk reward, to me, when you put together the data, is still quite positive for the equity market.
Amazing. So tell us a little bit about some of the other areas of the market, because we have this rotation that has been going on for a couple of months at this stage. This discussion about whether the actual market level can stay up or positive while this rotation happens. I'm kind of curious whether that matters to you one way or the other. I mean, can the overall market handle the rotation in terms of staying positive?
Yeah, so I think that's it. So Urian, I know that you talked to him quite
That's
a bit.
right.
He coins he coins the phrases like there's tech and then there's everything else. And this might be the time for the everything else market. I think to some investors that sounds like, and I'm not saying he's saying this, but to some investors think, well, if technology can't work, then the market can't work because it's such a big weight in the overall index. And I do not think the technology sector is in a dangerous position and needs to be bad or needs to go down on an absolute basis. I actually think that technology could outperform, but probably not as handily as it has over the last year. Look, I don't think tech is in the situation that we saw in 2000, where you had these very, very elevated levels of valuation versus what the fundamentals ended up being. We have technology companies, especially the Mag 7, that generate a significant amount of free cash flow, so much so that they're actually in the bottom half of the distribution in terms of being cheap on free cash flow, right? This is not something that we have seen in the bubble. So some of that mean reversion is actually priced in, which I actually think that, creates a positive risk reward for technology. Within that, I think that the surprise would be everybody either expects tech to be, I shouldn't say everybody, but many investors expect that technology will either do what it has done over the last year, which is lead the market by outperforming by about 1,000 basis points, or there are many investors who are saying it's time for the rotation, technology out of technology is going to underperform by a dramatic, 1,000 or 2,000 basis points. I think that the truth is likely just in the muddy middle, where technology outperforms, but perhaps not meaningfully, where other areas of the market actually are the leadership. And I think that the areas most poised to be leadership are in those interest rate sensitives like financials and REITs. I would add in those cyclical sectors like equal weighted consumer discretionary and equal weighted industrials. And I think that the downside leadership, and I'm always happy to talk about energy if you want to talk about downside leadership as well, is defense. So we've seen a little bit of a rotation into defense. And I say little when I look at the long-term downtrends on the charts, but certainly some people would say over the last 6 months, that's been the trade. I think that that is most likely to unwind in part because of all the data that I just explored with you. I think that there are really strong odds that utilities, healthcare, and consumer staples actually lag over the next year.
Materials is a free cash flow issue, or what is the go through some of those with us?
Yes, that is the free cash flow issue in materials. So I think unlike energy, while it is going in the wrong direction, you're at a pretty good level in terms of free cash flow generation and CapEx relative to sales, which still stays very low. Materials are on the complete other side of that. They have had a severe and very hockey stick-like acceleration in CapEx, with not nearly the same acceleration in sales. So we're now in the top half of the distribution on how quickly they have spent capital. And that means it is likely to weigh on free cash flow going forward. And I think that that situation is much more important because I know that there are many investors that are saying, well, if the US is cutting rates and China is stimulating and many other economies are joining in and cutting rates, don't I want to play a recovery play in terms of metals and mining and energy? And I think from a fundamental perspective, they are just off cycle, right? So they are, the CapEx is now excessive enough that free cash flow will likely be headed in the wrong direction over the course of the next year. So I don't think that they are likely to be the recovery play, nor do I think that energy is likely to be the recovery play.
I mean, there's also just the story of China in terms of demand, and that
Right.
just really there, I guess. That's sort of one of the pieces of the fundamental demand.
It certainly feels like right now, based on the data that I see in terms of the stimulus that they've delivered, that it almost looks like pushing on a string, right? Yeah. Given that they overbuilt excess capacity. So I think that as much as, look, I mean, it's been in a downtrend in terms of growth, but I think that the expectations for recovery have still been dampened over the course of the last year. And you might not see the slowdown that we've seen over the last year, over the next year. I'm not quite certain that we will see a recovery that we used to see in the past either.
Back to the signal versus noise discussion that you talked about. I mean, it was a big signal. I guess let's just get into that a little bit again, because why did they need to send such a big signal, I guess is the question.
I think that given the fact that so remember that I would disagree with them, but I think if you listen to the Fed's words, they think that most inflation comes from a tight labor market. And that was why, even despite the fact that core inflation ex shelter that I talked about in the CPI was at a level of 2%, there were many people on the FOMC that were concerned about the quote, tight labor market, that generating future inflation. Look, I think what the data has shown very clearly over the last 2 or 3 months is the unemployment rate is only one measure of tightness, right? And there are many others that are actually showing that wage growth will likely persistently slow. I think when that message came through loud and clear, that the unemployment rate isn't necessarily, even just the level, because it remains low, isn't necessarily a great predictor of sticky wages. I think that they came away from the fact that, well, maybe inflation resurgence isn't as much of a risk as they thought. So that 50 basis points gets you to jumpstart the cycle in terms of, remember, back to that level matters, right? It's not just that the labor market is loosening, but that we are in this 10 percentile range where we already hiked enough that maybe we're just a little too tight relative to the generation of wage inflation that we thought that the labor markets could generate. And I think that was I don't want to say error, but that was what they reanalyzed, I think correctly so.
You think correctly so, and maybe they were behind?
I don't know that they were behind, but again, because to me, it always looks like they follow the cycle rather than create it. But they certainly had room for it, right? They certainly had room for it based on the level that they started at.
If we go in just briefly to sort of more the cap size stories, the small caps, mid caps as well, you've been saying that mid caps are a more comfortable place for the last couple of months, and then July happened with small cap mania. What do we think now? Markets are moving,
Yeah.
but is this what small caps need?
Listen, so I think it depends on your risk tolerance, where you want to lean down the cap spectrum. So look, I think that the risk reward is positive for the stock market overall. As I look at the data, equal weighted looks better than cap weighted to me. Mid caps are a sweet spot in terms of they don't have the fundamental problems of small caps, but I think that they have a really solid risk reward. And then there are the risky small caps that are essentially the junk trade. All three of these indices, depending on how you want to measure it, have three things going for them. One, they're all rate sensitive and we're cutting rates. That's usually a positive historically. So that's a key change in the backdrop. That key change in the backdrop is happening on really advantageous valuation levels historically. So equal weighted versus cap weighted is now in the bottom quartile. Relative price to book on both mid cap and small cap are actually in their bottom decile historically versus the bigs. That has influenced your odds of outperformance and your average outperformance over the next year. And there is still fear palpable in the equity markets, right? So there are a lot of people who say, well, valuation spreads are pretty tight or narrow or not elevated in the S&P 5. And while that's true, they are as soon as you go to the Russell 3000. Right. So the further down the cap spectrum you go, the more elevated valuation spreads are, the wider valuation spreads are in my work, especially relative to credit spreads, the more likely there is to be a pain trade higher because you've discounted more than you might think possible in the equity market. So I think down the cap spectrum is still very, very attractive. For that, again, I would call it melt up risk. Whether or not you pick small caps, mid caps, or equal weighted, I do think it's just based on your risk tolerance. You're going to have a lot more variability in small cap indices. So you could make the argument that the risk adjusted returns are going to be lower in the small cap space relative to the mid cap space. That said, I've also heard investors say, well, I don't eat risk adjusted returns. I eat actual returns, right? So nominal returns are important to investors, but it always depends on your risk tolerance, what you're willing to do, what you're willing to bear.
And what would you say if we just go back to sort of the noise? I mean, there's literally, it feels like confetti going off, and there's lots of talking heads, not like you, because you're smarter than most of them, than all of them, I would say. But is that the noise? Just like, woohoo, relief, this is the noise, here we go. Is that what we need to be a bit careful with or parsimonious with?
Yeah, you always need to be careful with that, right? Because it's, you hear buy the rumor, sell the news all the time. And I think that in some ways you might have argued that you saw that yesterday. We still have a very strong period of seasonal weakness here in September. So I'm not sure that there's going to be an instantaneous reaction in the stock market. I mean, I think it's in the sense that there are very strong pockets of the market, small caps, and parts of the consumer that are very, very rate sensitive, that in some ways have borne out the impact of the Fed's cycle much more than large cap corporate America that can borrow in the debt markets with narrow credit spreads. And remember, 40%, I think it's 40% of homeowners in the US don't have a mortgage, right? So they weren't really impacted by rates. There's segments of the markets that are impacted by rates. That's where the confetti is right now. That doesn't necessarily mean it translates to every real GDP point along the spectrum, and it doesn't necessarily mean it translates directly into all stocks on the spectrum.
Right. Okay. Fantastic. Is there a final thought? I feel like that is a final thought, but is there one final thought you'd like to leave with investors now that we're here? It's a new day.
That is a good final thought. I would say that of the data that I look at, there's still upside to earnings growth, and that's the key driver to focus on, not the Fed.
Okay, fantastic. Denise Chisholm, a delight to get your perspective so quickly after this historic rate decision was made. Thank you. Have a great afternoon.
Thanks, you too.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.